go.
Streaming from South Africa to the world. This is the Stonks Go Moon podcast. What just happened? We break it down so you don't have to.
Welcome everyone to the Stonks Go Moon podcast. My guest today, Andreas Steno Larsen. He is the director and lead researcher at Heimstaden. Andreas, welcome to the pod.
Thank you so much, Rocco.
Andreas, what effects, if any, are the Russian or the sanctions that the global economy and the global political players have placed on Russia having on the EU economy in terms of your macro outlook?
Well, first of all, it's not good news. I think that's stating the obvious. But if you look at the trading links between Russia and the European Union, then we first of all have a very strong link between core countries in the European Union and Russia on energy.
Yeah.
But then if you look at on the export side of things from the European Union to Russia, then we have at least a couple of countries being relatively exposed to the Russian economy. For example, Italy, but also France and Germany. We're not talking big numbers if we look at it as a percent of the total exports of these economies, but it will still have a clear negative impact on the growth in the European Union this year. And if we compare that with the already high energy prices, then I would argue that it is almost a done deal that we get at least a light recession in the euro area this year, just as a consequence of what's going on in Ukraine.
Yeah, because I was about to say it's not as if the EU economy has been doing very well without taking all these things. So it's basically just making it worse.
Yeah, I mean, the outset was already kind of lukewarm due to the high energy prices that we saw through the second half of last year. On my models, just via energy prices, we should expect a GDP growth to basically contract this year. And then we have added this war in Ukraine on top of it, leading, of course, to contagious spillovers to at least the eastern part of Europe, but also core countries such as Germany and France. So it is, as I said before, almost a done deal that we will get a slight recession in the euro area.
Do you have any estimate ballpark for GDP in your forecasting?
Well, first of all, I think it's likely that we will have a negative growth print both in Q2 and in Q3. And if you look for the yearly figure, then I think ballpark would be around minus a 0.5%. So it's not a massive recession, but it's not good news.
Yeah, little recession makes it sound cute, right? I mean, it's like, we have a little recession, it's fine. We'll sort of go on. Which brings me to our next topic. It's this, you spoke about Germany and energy and the dependence on Russia. We've been through this now in the news, the oil, more so the natural gas for the retail and the industries. And Germany wants to, even if it wants to cut, it can't, right? Because it's so dependent. But now there's this issue of Germany wants to go green or has been wanting to, and in most parts have been going what they consider green. And my question is simply, does Germany have a green energy problem and why? And if it doesn't, what are they doing?
I think to understand why we are currently stuck in an energy crunch in Germany, we basically need to turn back time at least 10 years to understand this. I think it was in 2010, the German administration launched a program which they called Energiewende, which basically means the energy transition.
Yes.
And the whole purpose of that transition was to move away from nuclear, basically, and also coal towards gas and other sources of energy, for example, wind and solar. And this was basically further accelerated after we had the Fukushima disaster in 2011, which led to a massive headwind for the nuclear sector in Germany. So basically, the German economy has moved away from nuclear production and coal production towards gas and other sources over the past 10 years at a rapid pace.
Yes,
which essentially means that Russia is the main source of energy for Germany now in many ways. It's actually also the case for Holland to a certain extent. So this is an issue that several countries in the European Union deal with. And frankly, that is why it took the European Union so long to react to what Russia sort of manufactured already through the second half of last year, because I'm quite certain that the reason why we had so high natural gas prices already in Q3 and Q4 of 2021 was due to Russia not delivering as promised. So they basically tried to sort of manufacture a situation where they had the upper hand before invading Ukraine, and eventually they had that one right, Russia, I would argue.
Yeah, but it's funny to me, it's when Trump said that Germany needs to diversify their, you know what I mean? There's like the dependence on gas, whatever. There wasn't much love, and I guess it's because out of the mouth that it came from, because it was Trump, it's people like, what is he talking about? Turns out that maybe someone else was advising him to say that because they knew, listen, this was coming along. So my point being, up until this point, up until this geopolitical conflict, which I agree with you, started last year, it's not now. We're just seeing whatever was boiling under the surface coming to the fore. Now it's suddenly, now we have to do something. Instead of, hey, we should have done something long ago.
Yeah. But I mean, this energy policy is born and raised in the German administration over the past 20 years, and the ties to Russia were also very strong throughout the 2010s and also the early 2000s from between Russia and Germany. To take a very practical example of it, Gerhard Schröder, the former Chancellor of Germany, is the chairman of the board in Gazprom, and he's been so for quite a while. So I mean, it's the ties between Russia and Germany, they're so interlinked that this is very tricky to just roll back in a matter of quarters. But I think now they've basically got the perfect excuse to get rid of that bad policy.
Yes. Let's move on. Two parts. I want to, first of all, you made a Twitter post not so long ago talking about your long-term macro plays. I wouldn't say macro plays, but maybe like fund allocations in the long term. One or two of them I raised a bit of an eyebrow to some of them. If you can walk us through those. And then I think at the end of that, let's unpack your latest Substack a bit. So let's get going with what are your long-term picks and why?
Well, first of all, I am invested in the ARK ETF.
That is the one where I went, ooh, okay.
So as I also tweeted, I may need Cathie Woods to pay my bills soon if this continues. But joking aside, I was probably a bit too early on this rebound story for the tech sector. I thought that before Russia entering Ukraine, that interest rates would be about to retrace lower as a consequence of weaker growth. But I mean, the spike that we've seen in food and energy prices obviously wreaked havoc with that story. So I entered that bet too early. I simply have to admit that. But I stick to the position. I think a lot of the structural consequences of the COVID crisis will actually play into a decent structural case for the tech sector. One of the things being that the labor force is much less agile than pre-COVID, which essentially means that it's very tricky to recruit across borders, for example, currently. And to me, that's actually a relative gain for the tech sector, since it's much easier to work for Google remote than it is to work for an industrial company remote, right?
Makes sense.
to the extent that the labor force shrinks as a consequence of COVID, and also to the extent that the labor force is less agile as a consequence of COVID, I actually think that's a relative positive story for the tech sector. So that was my sort of long-term fundamental view on why I wanted to invest in that.
I want to ask you a question about Kathy specifically. Do you still, as an investor in ARK, trust her and or her analysts? No, but listen where I'm going, to basically find the next Tesla, because I get the sense that is what they're trying to do, because Tesla was her big play, right? That was her claim to fame, because she saw it before anyone else, basically. And now I'm feeling, and I don't have inside knowledge, I'm just looking from the outside and saying, it looks like I'm questioning some of her calls as dubious, and I'm wondering, as an investor in ARK, which I am not, but you are, do you still have faith in her? I guess you sort of answered it because you're still sticking with it, but I'd like to hear what your opinion is on that.
Well, first of all, I think she's been extremely wrong-footed on her view on energy, and
$12 a barrel, right? That was her call.
Yeah, and basically that's one of the reasons why the fund has struggled to perform, since she's also tried to sort of lead investments in the direction of technology, trying to solve that. But if you look at the fund composition, then I would actually argue that it is decently diversified when it comes to the composition of companies below the surface of the ETF. So I always find it very tricky to sort of bet on the winning horse early. So I basically prefer to have a bucket of potential winners. And then I basically hope that one of them ends out as the next Tesla. So in that sense, I'm not too scared of the fund composition, but no, I wouldn't trust Kathy herself to pick the next winner. I have to admit that.
Okay, great. All right, one or two others.
Then I think it makes sense still to have a bit of gold in the long-term portfolio. I've had that since I had just a penny to invest. And the reason is that gold is, first of all, the perfect tail hedge. So if everything turns extremely sour, then it is the right bet to have in your portfolio. We also saw that when Russia entered Ukraine. And then secondly, I mean, I wouldn't rule out a return to the gold standard at some point during our lives.
Those calls are becoming very loud, right?
Yeah, exactly.
Some form of return, if it's digital, backed by gold or something like that, like a variant, those calls are becoming very loud.
And therefore, you need to have something in your portfolio reflecting that, either via digital assets or gold. And I still put a larger probability on a new gold standard than a digital asset standard, but I mean, both could work. And therefore, I have a bit of crypto and a bit of gold in my portfolio as a consequence of that. But I still keep sort of the allocation at pretty low levels from the percentage term. But gold, I have between 5 and 10% of my portfolio placed in that, and then I have below 5% placed in crypto.
All right. Before we move on, just give me another one.
Well, then I always prefer to have a very, very broad equity exposure, just via an ETF to direct it to the MSCI.
Those are so boring, but so good.
I mean, it is very, very tempting not to have such an ETF in your portfolio, but it's also a very bad idea not to have it.
I'm completely, because people say, oh, but ETFs are so boring. Yeah, they're boring for a reason, because they work.
I mean, it's a cost-efficient way of having an allocation towards equities. And secondly, it's a very unbiased position, I would say. If you just have an ETF tracking the MSCI World or the S&P 500, whatever, in your portfolio, I simply think that's something that you need in your portfolio.
I completely agree, because if you were stock picking this year, you would have been absolutely royally screwed instead of just going with the big boys in any case and riding it out. Before I let you leave, you have a brilliant Substack called Steno Signals, and your latest post or article, I'm not sure what it's called on Substack, was called "How Do You Trade Stagflation?" Stagflation was something that was rearing its head, or the talks about it was last year. As far as I can see, we sort of started talking about stagflation in layman's terms, because we all know what inflation is at the moment because of JPL having said it so many times. And so even the layman on the street knows what inflation is, right? And to a lesser extent, I think deflation, but almost no one on the street knows what stagflation is. What is stagflation in layman's terms?
I define it as a quarter with, first of all, rising unemployment. Secondly, negative growth in the GDP.
Okay.
And thirdly, inflation being substantially above a 10-year average.
Okay.
So I would actually argue that we are moving towards such a scenario on at least 2 out of those 3 parameters.
Yes.
So we may get negative growth in GDP.
Yes.
And inflation
I think that's a given.
Above.
I think that's a given, right? Because I mean, it's not the data and the charts or whatever, they don't lie, because that's going to happen. It's the only one is like the unemployment, which is hard, because even when you listen to the Fed chairman speak, he's very sort of he says he's how can I put this? He's cautious when he talks about employment, but he also he hits at home, right? We are looking at employment, we're looking at stable employment, bringing the unemployment figures up, stuff like that. So I don't know what exactly will happen there.
No, and usually unemployment or employment is sort of a lagged consequence of growth, I would argue.
Yes.
So if we see negative growth this quarter, I think that's almost a given, as you say.
Yeah.
Then we may see rising unemployment like 6 months from now. That's usually what happens.
Domino effect. Okay, I'm with you. That I get. Right. So 2 out of 3, very good looking. We're going in that direction. All right. So for the retail guys investing or trading or whatever, participating in the market, and obviously they have to go and read your Substack, but how would you trade stagflation? How would you play?
I had a look at data since 1973. That's as far as I can go back. And then I looked at quarterly returns through these periods where you actually had true stagflation. So rising unemployment, weak growth, and inflation above average. And interestingly, the best asset at all is gold. So that's essentially why you need to have gold in your portfolio. It is the best tail hedge you can find.
Okay.
Then if you look at commodities broadly, so everything from industrial metals, for example, but also to energy, then they also tend to perform through such a period. Basically, maybe we see that right now. Because I mean, commodities have been moving up, right? More or less, no matter where you look.
Doesn't matter.
Then the final thing that's interesting is that real estate tends to perform, and it is possible to invest directly into real estate by ETFs as well. So I think the reason is that real estate is decently protected against inflation as well, since rental growth is linked to inflation. And therefore there's kind of a perfect sort of shelter in real estate as well. So those are sort of the 3 things that work.
Your 3 main pillars. How long, let's say, I see in your Substack, you said we are not in the 1970s, because there's a lot of people who said we are in the 1970s and this is how you want to play it. Why do you say we're not in the 1970s?
I think there are a few mega differences to the 1970s. First of all, we don't have a massively growing labor force. We had that through the 70s.
Yeah, it's aging. It's an aging one, right?
Yeah. So in contrast to the 70s, we have excess savings, and they continue to explode saving rates among, in particular, those being able to save. that's one of the reasons why interest rates remain low right now, even with inflation running at 7-8% in many countries. We still have low interest rates. I think that's a consequence of savings more than a consequence of central bank policies, actually. And therefore, we have a big difference between the environment in the 70s and the environment that we have right now, due to the differences in savings in households. So that's one thing. And then I struggle to see that the labor force holds the upper hand in negotiations with the employers to the same extent as they did in the 70s. We had very strong labor unions in the 70s. We don't have the same kind of coordinated wage efforts across the globe today as we had in the 70s. And I also think that that is reflected right now. If you look at wage growth, it is running way below inflation right now, while wage growth basically followed inflation to a very large extent in the 70s. And that's also a game changer for sort of this potential wage price spiral that we had in the 70s. I don't think we will get that through the 2020s here.
That's really interesting. Andreas, thank you so much for joining me today. If the listeners want to connect with you, where can they do that, and where can they subscribe to your Substack?
My Substack is called Steno Signals, and you can find a link to it on my Twitter profile. So I'm also on Twitter, Andreas Steno Larsen.
And connect with him on LinkedIn as well. To our listeners, peace, love, and prosperity, and we'll catch you in the next one. Cheers.